Good evening, ladies and gentlemen. Welcome to day 3 of FSM ETFestival. So our theme for this evening is easy to focus, whereby we zoom into specific investment ideas that can be beneficial for your portfolio. Also, this is just part 1, so stay tuned for part 2 tomorrow. Okay, so for this evening's agenda, we have with us Mr. Tan Te-Shin, who will be sharing about the technology sector and its growth opportunities, and Mr. Kelvin Neo from Nikko Asset Management to discuss if we should be focusing on more STI companies, REITs or bonds. So now we'll begin our first session of ETFestival. So technology companies are among the best performing stocks this year, defying expectations that the downturn brought about by the COVID-19 pandemic will cripple the global economy. So let us take a closer look at the tech sector, its importance to the global economy, and the mega trends supporting the future growth of this sector. So let us welcome Te-Shin, FSM analyst with the research team at Semiconductor, to take us through a closer look at the tech sector, its importance to the global economy, and the mega trends supporting the future growth of this sector. So over to you, Te-Shin.
Okay, thank you, Sarah. Good evening, everyone. My name is Te-Shin, and welcome to day 3 of ETFestival. So I'm a senior equity analyst here at FSM1, and today I'll be sharing about whether or not should you invest in technology stocks right now. So if you have been keeping up with markets, you would know that technology stocks are among some of the top performers during the recent market rally, defying expectations that the downturn brought about by the COVID-19 pandemic will cripple the economy. With the sector as a whole recovering substantially from its March lows, I believe that many of us are faced with the question of whether or not should I still invest in technology stocks at this point in time. But before we can answer that question, I feel that it is important for us to have a clear understanding of what the tech sector is all about. So let's begin with a quick introduction to the tech sector. And I think we can start by defining what a tech company is. So according to the Global Industry Classification Standard, otherwise known in short as the GICS standard, the tech sector comprises of companies from the following 3 industry groups. First of all, we have software and services. Second, technology, hardware and equipment. And third, semiconductors and semiconductor equipment. So the thing is, if we go strictly by this definition, a company like Apple would qualify as a tech company, but the rest of the FANG stocks, which are Facebook, Amazon, Netflix, and Google, they wouldn't. And that hardly seems appropriate because whenever someone talks about technology, the first thing that comes to mind are the FANG stocks. So, and if you think about the Chinese tech sector, the first few tech names that come to mind would be the bad trio, which is Baidu, Alibaba, and Tencent. Thus, in order not to leave out some of the most largest and promising companies out there which may not fit into the traditional definition of a tech company, we ought to broaden this definition slightly. So our interpretation of what constitutes a tech company is not limited to those that are involved in the manufacturing of technology products or providing technology as a service, but it also includes companies that rely heavily on various digital technologies, such as the internet, to conduct their business. So that way, companies like Amazon, which is the largest e-commerce and cloud computing company in US, and Meituan Dianping, which is China's leading super app for services, may be classified as tech companies. So we feel that the tech sector today, the best description for it would be a super sector consisting of multiple subsectors such as semiconductors, software, e-commerce, cloud computing, just to name a few. Okay. There's no doubt that in today's world, technology has become an indispensable part of our lives, one that is hard to live without. The growing importance of technology is also reflected in our financial markets, as the top 5 companies by market capitalization today are all technology related compared to only 2 a decade ago. So if you look back at 2010, the top 5 companies there, the only 2 tech names are actually Apple and Microsoft. The rest of the 3 companies, ExxonMobil, PetroChina, and BHP Billiton, they are all from the energy and the oil and gas industry. But if fast forward 10 years to today, the largest companies, Microsoft and Apple, they are still there, in addition to Facebook, Amazon, and Google. So in fact, the technology sector has already become the most valuable industry in the global economy after overtaking the financial sector back in 2016. But the thing is, despite its rapid growth over the past 10 years, the tech sector is still not showing any signs of slowing down yet. So right now, the world is on the cusp of a new technological revolution known as the 4th Industrial Revolution. So this marks a turning point in human history where the widespread use of digital technology, such as the internet, is blurring the lines between the physical and the digital world and forever changing the way we live, work, and interact with one another. So unlike the previous 3 industrial revolutions, digital technologies today are evolving at such breakneck speeds that individuals and businesses alike are finding it hard to keep up with the changes at times. And those who fall behind, they run the risk of being rendered obsolete. So the consequences of failing to keep up with technology is exemplified during the COVID-19 pandemic, during which many traditional physical-only businesses have been severely affected by social distancing measures. So case in point is the retail industry, where several brick and mortar retailers such as JCPenney's, Model Sporting Goods have filed for bankruptcy during this period. And as we can see, these technology-driven changes brought about by the fourth industrial revolution, they are no longer confined to just the manufacturing and the industrial sector. Almost every corner of the economy, from retail to banking and even the services industry, has been affected by technology. So the rapid growth, the rapid digital transformations happening across all industries and sectors will bring about many new investment opportunities, and especially for the companies that are able to adapt to these changes quickly. And as more companies go digital, we believe that technology will likely become an integral part of every investor's portfolio. So as mentioned earlier, tech stocks are among some of the strongest performers during this period in terms of share price performance. So returns of technology-focused ETFs have far outpaced the broader market, rewarding investors who have held on to them throughout this difficult period. So over here, we have a chart of several tech ETFs versus broad market ETFs. So we have broad sector ETFs like XLK, which is the Technology Select Sector ETF, as well as ETFs that focus on a particular subsector of the technology industry, such as the VanEck Vector Semiconductor ETF, which invests in semiconductor companies, as well as the First Trust Cloud Computing ETF, which invests in the cloud computing industry. And as you can see from this chart over here, the performance of these tech ETFs are a lot better than the broader market compared to markets like the S&P 500 and the MSCI World ETF, suggesting that technology may actually be more resilient compared to other sectors. So even though valuations might seem expensive at the moment, we continue to hold a positive view on the technology sector over the long term for its massive growth potential. So the thing is, unlike the past, valuations of technology companies today, they are a lot more sustainable thanks to an improvement in fundamentals such as earnings growth. So if you think back to the dot-com bubble in the early 2000s, right? Almost any company in the market out there with a .com at the back of its name would warrant very high valuations. And as we all know, that didn't turn out well. But what we think is that the technology sector today is actually fundamentally different from what it was 20 years ago. So the sector is also driven by several long-term megatrends such as digital disruption, rising internet adoption rates, and the Internet of Things. Though it is very difficult to put a price tag on innovation, we firmly believe that given its structural importance to the global economy, the tech sector remains highly attractive for investors who are able to stretch their investment horizon out further. So because of the multifaceted nature of the tech sector, I'll be focusing on two sub-sector ETFs which we really like. This way, I hope that you can have a deeper understanding of what these subsectors are all about, and as well as their growth drivers, competitive advantages, and ultimately why we like them. And if you like these ideas, you can consider allocating a small portion of your tactical portfolio to them. So remember, these ideas are tactical ideas and are not meant to take up the bulk of your portfolio. So please do not invest all your money into them. Right, so we'll start with our first idea, which is the cloud computing industry. So cloud computing, it refers to the delivery of computing services, such as processing power, storage, software applications over the internet. So unlike traditional IT infrastructure, cloud computing differs by hosting everything on the cloud, which is off-premises. In the past, companies had to purchase, install, operate, and maintain their own hardware and software. And this requires a lot of time, effort, and money. But with cloud computing, companies essentially they rent access to all these services and pay a fee based on what they use. So the invention of cloud computing removes the burden of maintaining IT systems, which frees up precious time and money, which the business can then use to grow its core business. So over here, we have the three basic cloud service models. So starting at the bottom, we have what we call infrastructure as a service. So this is where third-party cloud providers deliver infrastructure services such as data centers, servers, and storage over the internet. And users can then install their own OS and applications. So examples of companies that operate in the IaaS sector are Amazon, Microsoft, and Google. So moving on, we have what we call the platform as a service. So this second model, it actually builds on the infrastructure as a service model. It includes everything that IaaS has, in addition to middleware, OS, and other development tools. So most platform as a service providers are also infrastructure as a service providers. So you can expect to see similar names there again, Amazon, Microsoft, and Google. So moving on to the last one, which is software as a service. So this is where I think most of us are actually familiar with it, even if you don't know what it is. So this is where software as a service is where third-party providers actually host their applications on the cloud and users connect to them. So most of the apps that we have nowadays on our iPhone, they are all considered software as a service. And most of the software that we use, for example, Office 365 from Microsoft, Adobe, Photoshop, they are all considered software as a service. So now let's talk a little bit about why we are positive on the cloud computing industry. So in today's world, oil is no longer the most valuable commodity. Data is. So we live in a data-driven world where big data is generated with every digital process. So last year, 41 zettabytes of data was generated, and that's actually equivalent to 820 billion Blu-ray discs. So the deep insight and knowledge that can be extracted from raw data through analytics is hugely valuable. E-commerce companies, they collect data to gain a deeper understanding of consumer preferences and shopping behaviors, enabling them to make more personalized recommendations and improve the overall online shopping experience. And on the other hand, digital advertising companies collect data on internet users, analyzing search terms and user habits to place targeted advertising besides the regular search results. So given the vast amount of data generated and the limitations on traditional storage solutions, cloud services have been gaining traction quickly. So much so that the industry revenue is forecasted to grow at a compound annual growth rate of 16% from now to 2022. So right now, the cloud services market is actually dominated by three players: Amazon, Microsoft, and Google, with Amazon taking the lion's share of 33%. So if you notice, none of these three companies actually started off as cloud computing companies. Amazon started by selling books online and then gradually moved on to selling almost everything else you can find. And for Google, I think we're all familiar that Google started off as a search engine. And as for Microsoft, it is best known for its software such as its Windows OS as well as its Microsoft 365. So over the years, these companies slowly pivoted their businesses towards cloud services as they all saw tremendous growth opportunities there. And today, these three companies are among the largest in the world. So another factor that contributes to the rise in the cloud computing industry is the rising popularity of the software as a service model. So as of late, there has been a sharp rise in the number of SaaS companies due to the growing popularity of the cloud-based distribution model. So not only are there more new SaaS-based coming into the market, such as Zoom, Slack, so on and so forth, existing software companies are also transitioning to traditional software distribution model, from the traditional software distribution model to the SaaS model. So one good example is actually Microsoft. So in the past, Microsoft used to sell most of its software in the form of single package licenses. But today, most of Microsoft's sales actually comes from a subscription-based model, which in other words, it's the software as a service model. So the rising number of software as a service companies is also another catalyst that will drive the cloud computing industry forward. Now, for investors who would like to invest in the cloud computing industry, you can do so using our recommended ETF, which is the First Trust Cloud Computing ETF. This ETF is traded in the Nasdaq Stock Exchange under the ticker SKYY. So this ETF actually tracks the performance of a basket of cloud computing companies, such as Amazon, Microsoft, and Google. These three companies are actually among the top holdings in this ETF. So the constituents of this ETF, they have to meet certain criteria, which includes minimum market cap, free float, and average daily volume. So I believe on day one, my colleague actually covered some of the criteria that you should look at before you invest in ETF. So I've listed some of them over here. So as you can see, assets under management of the ETF is pretty decent considering it's a niche subsector ETF at about 4.73 billion US dollars. Expense ratio is also rather low at 0.6%. And on top of that, average daily volume, it is quite healthy, so that you probably can get in and out without much hassle. Yep. Okay, so that's it for the cloud computing industry. I'll now move on to the second idea, which is on the semiconductor industry. So all of the latest technology that we have, all the gadgets like smartphones, self-driving cars, cloud computing, they all share one thing in common, and that is they are all enabled by semiconductors. In fact, semiconductors form the bedrock of all technology. Without advancements in semiconductor technology, technological innovations would simply stop. So for those of you who are not familiar with the semiconductor industry, companies that are in this industry generally fall into one of the following three groups. So first, we have what we call the pure play foundries. So these are companies that do not have any design capabilities, as they focus only on the fabrication and testing of semiconductor products. So examples of companies that are operating in the foundry space is TSMC, which is the largest foundry in the world. Other smaller foundries would be SMIC, UMC in China and Taiwan. So on the other end of the spectrum, we have what we call the fabless companies. So fabless companies, they essentially are the exact opposite of your foundries. They don't have any manufacturing capabilities, and they only do the design and sale of semiconductor products. And what they do is after they actually design all these semiconductor chips, they actually outsource their fabrication to foundries. So doing so has actually several advantages. It allows the fabless companies to stay asset light, which means that they don't actually have to own a fab, because owning a fab in this modern time is actually very expensive. Modern day fabrication plant can cost as much as 10 billion US dollars, and it is also very expensive to maintain and operate it. So by outsourcing to foundries, right, they can actually focus more on their design and make faster, smaller chips. So the last group of companies is what we call integrated device manufacturers. So these are the companies that basically do both. They do both the design and the manufacturing. So one good example is actually Intel. So one of the advantages of this IDM model is that the company can actually control every step of the process, all the way from design all the way to manufacturing. Now I'll share a little bit more about this industry. So as of 2019, US companies still control the majority of the market, with a market share of nearly 50%. So the dominance of US companies in this space is not something that happened by chance. Rather, it is the result of the hundreds of billions of dollars spent on R&D over the years. So as you can see from the chart, China only has a market share of 5%, but it has laid out big plans to close the gap. So part of China's Made in China 2025 plan is to be self-sufficient when it comes to semiconductors. So one reason China is actually embarking on this plan is because the ongoing trade war has revealed just how vulnerable it is, as bans on Huawei and ZTE over the past few years have had a significant impact on their operations. So the intensifying competition for dominance in the semiconductor industry just goes to show how important semiconductors are to a nation's progress. Now moving on, let's have a quick look at some of the emerging technologies that will drive semiconductor demand. Of course, this list is not exhaustive. If you think hard enough, you can definitely think of many other demand drivers, but here are three that we have identified. So first, we have the deployment of 5G technology. So for 5G, hardware such as your smartphones and base stations, which are the equivalent of cell towers, would be required, upgrades would be required for them in order to be 5G ready. So naturally, more hardware upgrades is in a way equivalent to higher semiconductor demand. So the second demand driver is actually increasing smartphone penetration rates. So three of the most populous countries in the world, China, India, and Indonesia, they have an average smartphone penetration rate of just 42%. So this is much lower than the developed markets penetration rates, which usually range between 85 to even 95%. And for many of these emerging countries, right, smartphones are actually the main device that its citizens use to go online. So instead of in developed nations where most people have a computer, smartphones are actually the key device that citizens in emerging countries use to go online. And as the smartphone penetration rates in these emerging nations converge towards developed markets, we think that this would drive semiconductor demand as well. So last but not least, we have the Internet of Things. And so the Internet of Things is basically, it covers many things. So like smart cities, smart homes, wearables. So things like smart home devices will be your Google Home, your Amazon Echo. Those are considered Internet of Things. So it is projected that by the year 2025, there will be a threefold increase in the number of connected devices at about 75 billion. Now moving on, so some of you might have concerns about investing in the semiconductor industry as it is known to be cyclical, as you can see from the chart over here. So the line in yellow actually depicts the sales growth, and there are times where sales growth can tumble by more than 30%, as we have experienced during the 2008 GFC as well as the 2001 dot-com bubble. But the thing is, given time, it eventually recovers to higher levels than before, and so do share prices. This is because as the world becomes increasingly digitalized, the demand for semiconductors will always be there. Thus, whenever a downturn happens, it is not a question of whether or not a recovery will occur, but rather it is a question of when will the recovery take place. And at this point in time, we think that the semiconductor industry, having gone through a down cycle over the past year and a half, we think that it is ripe for a recovery. So, all right, this slide here pretty much sums up what I've just said, and that is without semiconductors, all the technology that we enjoy today simply would not exist. And as the world becomes increasingly tech-driven, the future is bright for semiconductor companies. So if you'd like some exposure to the semiconductor industry and the companies within it, you can consider using the VanEck Vector Semiconductor ETF. This is actually the recommended ETF we have for the semiconductor industry, and it is listed on the Nasdaq Stock Exchange under the ticker SMH. So this ETF, it tracks a basket of companies which are involved in semiconductor manufacturing as well as equipment manufacturing. So it employs a modified market cap weighting in methodology, which favors not only the largest, but also the most liquid companies as well. So top holdings, you can see from the table on the left, many familiar names: TSMC, NVIDIA, Intel, AMD. Yeah, I'm sure you find many names over there familiar. So talk a little bit about some of the metrics of the ETF. I think for assets under management, it has about $2.7 billion as of last week, and expense ratio of just 0.35%, which is, I believe, the lowest expense ratio among all the semiconductor ETFs out there in the market. And on top of that, average daily volume, extremely high, 4 million, which means that we can probably get in or out without any difficulty. Okay, so with that, I've come to the end of my presentation already. I hope that through this session, you have managed to gather some useful information, ideas, and insights for your investment portfolio. I'd just like to remind everyone that the two ideas that I've shared today, they are tactical ideas and they are meant for your tactical portfolio. So please do not invest all your money into them, but rather maybe you can gauge your portfolio you can gauge risk from a total portfolio perspective and decide how much you want to allocate to these two ETFs should you decide to do so. And I wish you all the best for your investing journey. Please continue to stay safe, and thank you once again for joining us in our ETF Festival 2020.
Thanks, Sajid. So moving on to our next segment, we have Asset Management with us today. So Nikko AM is a manager to 4 Singapore-listed ETFs covering Singapore equities, Asia ex-Japan REITs, as well as Singapore dollar bond markets. So in their presentation, Kelvin Neo will be sharing with us what their ETF managers are most concerned about over the next 6 to 9 months, and also discuss some top-of-the-mind questions like whether the STI will continue to lag the broader equities markets, if bonds are worth their low yield, and whether REITs are the best place to seek safety. So they'll be talking about the Nikko AM SGC Asia REIT ETF, and their ticker names are CFA and CIO. So we'll be pasting that in the chat shortly. So now let us welcome Kelvin Neo, ETF Business Development Specialist at Nikko Asset Management in Singapore. So Kelvin, please.
Yeah, hi. Good evening, everybody. Kind of good to see you online. First time I'm doing the ETF Festival via Zoom. So in the previous years, we have always kind of met in person. So today, I'm going to talk a little bit about whether or not in the investment climate today, you should own more STI companies, more REITs, or bonds. I think this is a question that is very close to heart for many Singapore investors. I'll kind of skip the company section and kind of just jump straight into my presentation proper. So just a very quick recap for Nikko Asset Management in Singapore. We have 4 ETFs listed on the Singapore Exchange. And as Sarah has mentioned earlier on, they are the STI ETF, the AXJ REIT ETF, the ABS Singapore Bond Index Fund, and the Nikko AM SGD Investment Grade Corporate Bond ETF. Important to note for listeners is that each ETF has a different underlying asset class exposure, which is kind of listed at the bottom of the table here. So all 4 different asset classes. And this is a very busy chart. I won't go much into it, but maybe I'll just kind of point out that the collective assets under management for all 4 ETFs, you see on the first row in this table is about close to $2.5 billion Singapore dollars. And here are just some stats on the ETFs, which you can definitely kind of find out at your own time. Okay, to kind of start off the presentation prop, I think, really when you kind of think about whether or not you want, Singapore equities, REITs or bonds, is really important to get a good sense of the macroeconomic environment in Singapore. So here on this chart here, I'm kind of just showing you some key indicators that that we typically look at, and it's very obvious that the economic activity in Singapore plunged in the first half, on circuit breaker measures due to the COVID-19, and right now, the big question on everybody's mind is, how will the recovery look like? Now, if you kind of look at the left chart here in terms of growth and PMI, which means Purchasing Managers Index indicators, you'll see that be it both manufacturing as well as electronics PMI has collapsed in the first quarter of the year, and the GDP growth has also collapsed likewise. You might see a little bit of rebound in the PMI in the recent months. Right, and this really kind of reflects, some improvement in manufacturers' sentiment of the overall market. But it's important to note that, this is off a low base. If you look at the right chart on domestic indicators, you kind of see here 3 lines here. The dark blue line just tracks private residential prices. The light blue line tracks bank loans, the growth in bank loans by our local banks. And then you have the green line, which kind of tracks retail sales, ex auto sales. And definitely it's very clear that retail sales has collapsed, right, together with our GDP growth, right? And what you're seeing in terms of residential home prices as well as bank loans is that they're not really growing at all. Right, you'll see that the light blue line as well as the dark blue line, they're probably hovering very close to zero, which really kind of reflects, the challenging economic climate that Singapore is going through. Now, you kind of see, so on this slide here, I think, there is there's nothing to hide here. Singapore, at least in the first half, is in recession, right? For the full year, our GDP growth is expected to be -7 to about -5%, right? So it is a very challenging year. And then in terms of inflation, inflation is looking a little bit soft. Right now is trending just below 0%, right? So prices overall in the economy are not going up. They just kind of just it's almost like a lockdown, right? So everything is a standstill. But I think generally kind of going forward, a lot of how these indicators will trend really depends on how COVID kind of plays out over the next few months, whether or not the broader economic climate globally improves. And we'll touch a little bit on that as we go along. Now, so non-oil domestic exports, which is the NODX, an indicator that some of my investment managers look at. It appears to have bottomed. All right. I mean, I chose this chart. I kind of picked it up from an article from Singapore Business Review. I kind of like this chart because it has a 3-month moving average number. And you'll see here, in terms of non-oil exports, which is a very important metric for Singapore, being a very export-driven or dependent economy. We're kind of, from a trend perspective, it seems like the bottom was hit sometime in mid last year. And even with all the negative news that we are reading in the press today, if you kind of look at where the data point is in as of June, Nordex year-on-year growth is actually positive. It's running at from about 6% year-on-year to about 10% year. All right, so from a data perspective, this data doesn't look too bad. But of course, the full year forecast is still quite soft. I mean, consensus is looking at anywhere from 3 to 5%, which means that actually the second half there can be downside risk. But really, I think the key thing here is really for investors yourself to kind of measure, right? I mean, you can get a sense of how you see the overall economy moving. I mean, is economic activity coming back, etc. And kind of measure it with what you read in the press, whether and how the elections in the US are going, how the relationship between China and the US is developing. I think all this does give you your own sense, maybe, to think about whether or not the second half will be weaker than the first. Yeah, I thought I would just share some insights from my investment managers. So for this presentation, so kind of what I did was that I went to some of them. These are the PMs for our ETFs. And I kind of just popped in a question. It's like, hey, Winston, and Winston is the face that you see here. He's the senior portfolio manager for 2 of our ETFs, the STI as well as the Asia Japan REIT ETF. And I kind of asked Winston. I said, hey, Winston, it's like, how do you kind of view the markets, right? Over the next 6 months, towards the end of the year and maybe kind of entering 2021. So kind of just to quote him, it's like he does think that the resumption of economic activity in Singapore, as well as neighboring countries, is the natural, is really the natural but gradual equity market catalyst, right? A lot of you are thinking, how will the markets trend forward? And really, what you see, the activity that you see, at least in Singapore, should give you some comfort in terms of where economic activity is heading. And in many ways, this is a leading indicator. I mean, just about a month ago, if you went out to the streets, it was empty. Taxi drivers really had no business. You had queues, like, long queues of taxis. I think generally there's a little bit of improvement here. If you go out to the streets today, activity is coming back. So for Winston, I think one of the things that he looks at, similar to many other investment managers, is the risk of a potential second wave of infections, rising again. And of course, this may, and I use the word may, lead to the tightening, and the implementation of social distancing measures again. Right. And on the chart that you see on the right side here is really, the number of new COVID cases in Singapore, the daily cases. And it's encouraging to see that, the cases are coming down, right? So I think the Singapore government, has been doing a good job, at least, in terms of containing the virus. I mean, they've picked up quite a bit after the elections. So it's quite positive, right? So on this note, between the Singapore STI companies, as well as Asia Japan REITs, I think, from Winston generally thinks that the REIT markets are a little bit more positive, right? He does expect tenants, to come to kind of see, a pickup in business in the second half, and like I mentioned, the return of activity is actually quite fairly observable. right? And plus the fact that REITs, from a investment perspective, at this point, still pays fairly good, dividends and income, which is fairly high. I think right now for the Asia ex Japan REIT index, I think it's still running above 5%. That's the gross index, gross yield, right, at about 5%. So that's on the REITs. For the STI companies, is I think relatively weaker than the REIT market, and of course, if you followed a little bit of the news, this is probably weighed down a little bit by how the banks are doing in Singapore. I think generally market expectations are that banks will kind of take a little bit of hit on the earnings, given they're expecting higher, MPL, and by MPL I mean, bad loans provisions, going into the second half. Plus, the banks are also exposed to the broader economy in Singapore. And it was quite clear based on the data that we are seeing, that right now, at this point, the Singapore economy is still undergoing a rough patch. Yeah. So we kind of touch a little bit on the Singapore equities as well as the REIT markets. All right. I also want to in this slide touch a little bit on fixed income. For those of you investors who kind of like the fixed income market, right? So this slide here kind of gives you a good sense of where Singapore bond yields stand relative to the region, in Asia, and of course versus the US. So Singapore is and this chart shows you the 10-year government bond yields. Singapore is the bright yellow line, okay, at the bottom of the pack, right? As of about 7 August, the yield is running at about 1.5%. Bottom of the pack on the diagram, but really not probably top of the whole pack in terms of sovereign credit quality. So Singapore has a AAA credit rating, sovereign credit rating. That's very, very high quality. So, although the yield is a little bit low, relative to what we can potentially earn in the region, the credit quality is probably the highest here, right? And of course, if for investors who want fixed income, you could definitely go for government bonds in Indonesia or or even India. That runs about 7 to 8%, but of course the risks in these economies are much higher. Now, we receive a lot of questions from investors once in a while, right? They ask us. I wouldn't say they complain, but they comment. They give us feedback, good feedback, that the yields for Singapore or Singapore dollar bonds that we have, that our ETFs track, the yields are a little bit low. And so I did before the webinar, kind of did a bit of check on my own. And indeed, if I look at our ABF ETF, as of July, the yield to maturity is only 1.1%. 1.1%. And the duration is probably somewhere around 8. All right. So yields have gone down, duration have gone up. Fair to say that Singapore government securities have become a little bit more pricey. All right. And for investment grade corporate bond, the yield to maturity as of July is still a little bit higher at around 2.3%. All right. And the duration has not moved much. So, I think what I wanted to kind of point out here is that if you think the yields on Singapore government securities as well as investment grade corporate bonds are low, wait till you kind of see the updated fixed deposit rates that are published by the banks. And I was quite surprised myself. If you were to go, I just did a Google, right? So this is just coming up from the website. For amounts that are between 50,000 Sing of fixed deposits at DBS to about 1 million, the yield is only 0.15%. All right. So, I think generally the point here is that yields have compressed quite a bit. And even if you were to go for SSB, Singapore savings bond, the 1 year yield is also quite close to, it's also quite low. It's running at about 0.27. right? So just to give everyone a sense that yields actually in Singapore, they've all come down quite a bit. But the interesting observation here, and in this chart, I wanted to show that, if we reference the Jackie composite, yields are actually back to March levels, right, after spiking, in early April. Now, so Jackie, just to inform, just to kind of, explain this. So the Jackie is actually is a very popular benchmark for Asia credit. It's actually the JP Morgan Asia Credit Index, and it is a broad-based US dollar denominated, Asia debt benchmark, and it just tracks the overall performance of US denominated debt instruments in the Asia region, right? So this is more like a broad benchmark for Asia credits. And like I mentioned earlier on, if you kind of look at the composite itself, which is the dark blue line, you'll see that right now the yields are running at about 3.62. But as I've mentioned, the key point here is that after spiking in March, because the yields spike in March during the onset of COVID, so the market was very nervous. I think globally, bond yields all spiked, and this spike, the spike happened whether or not you were investment grade, meaning high quality bonds, or high yield, which is lower quality bonds. But the thing is, the interesting thing is that the yields have all come back down. So today, the market views credit instruments from a yield perspective not too different from just before COVID started. So it's almost like everything is back to normal. At least that's what is represented on the yield portion here. But I mean, personally, and I'll just share a personal note, this looks a bit off. I mean, it doesn't really make much sense in the sense that you can't have both investment grade and high yield interact in the same way, given everything that's happening in the market today, right? And I mean, from at least personally, the way I look at this is that part of the reason why yields have come back down is really because the underlying demand for high interest rate products or income or even is actually quite high. So there's a lot of money chasing yields and fixed income, and to a certain extent, that's also driven by the huge amount of liquidity that's available in the markets today. So so invest in fixed income, carefully. Okay. This slide, what I really wanted to do was to kind of help everyone take a step back. We started the presentation, with a single question in mind. Should we go for equities, Singapore equities? Should we buy REITs or should we buy bonds? Now, I know if you kind of take a step back, and look at and let performance give you the answer, long-term performance. What you see here is really the long-term performance, like a decade of performance between Singapore government bonds, which is the light blue line, versus Singapore equities, which is based on the STI. That's the light blue line, the slightly green line, I would say, slightly green line, and the dark blue line, which is Asia ex-Japan REITs. So, kind of like the performance of REITs is very obvious. Over the past 10 years, it's probably from a total return perspective up about 400%, right? If you bought Singapore equities, you doubled your money. And if you bought bonds, you would have only earned about 50% return. So it would seem like REITs have, from a historical perspective, definitely looks more interesting. But remember, it's Singapore equities or Singapore REITs, they are very volatile instruments. And you will see here, over the past 10 years, what we think are major periods of market stress. Let's say, for example, the Europe sovereign debt crisis in 2011, in 2013, taper tantrum, when Bernanke wanted to raise interest rates. You had the oil price war between the US and Saudis in late 2014, and all the way up to today, right, where, early this year, where the markets corrected massively, due to the COVID. And you'll see here the volatility is very, very high. it might not be so obvious in the charts that you see here, but you know, the drawdowns that you can see here can range anywhere from about 10% to close to 50%. So these drawdowns are very, very significant. And it's really important for investors to keep that in mind when you are thinking about, you know, where we are in the economy today, the kind of risk that we are seeing in the markets today, you know, what you read in the papers, the data that you see. And if you're still holding on to a 100% equity portfolio, you know, and it could be REITs or Singapore equities, because the correlation between the two is probably around 0.5 to 0.6, so it's fairly high, right? They're still equities overall, right? Just that one pays more income. You might want to consider diversifying, and I use the word diversifying, you know, not say, you know, switch 100% to some bonds, you know, whichever way, you know, depending on how you kind of think about the bond exposure that you want. Having a diversified portfolio, a bit cliche to say this, but really has got the effect of preserving your capital. You know, if you were a 100% equity investor today, your wealth just halved, and you would just have you probably have to just sit and wait for the recovery to happen, and it will take some time. On this slide here, I just wanted to kind of zoom in a little bit to what has been happening, or what might have been happening in the marketplace for the past 2 years or so. So the question when you kind of look at this slide is to, the question here, which we receive quite a bit too, is, so in today's market, you know, over the past 1 or 2 years, is the market risk on or risk off? You know, are investors positive, bullish, or negative? So what I try to do here is to kind of let the performance of the different asset class speak for itself. And you will see here there's only one line that really goes up, and that's Singapore government securities, represented by the light blue line, the ABF Singapore bonds. Right? That if you were to benchmark, rebase this to the start of 2018, this you know, bond Singapore government securities, you know, is up roughly about 20%. Now, 20% returns for Singapore bonds, you know, pretty impressive. And you know, in contrast, you know, you kind of see the sharp pullbacks in the equity markets, be it Singapore equities as well as Singapore REITs. Now, and it's important to understand that this whole period, this whole 2 years, is also defined, or rather, it coincides with you know, the period where the US starts to impose trade tariffs on China. Right, and what it tells us, or what I suspect, is that, you know, it's very important to see what's happening between the US and China, because it is the overarching theme that to a certain extent is determining whether or not the markets are, you know, truly bullish or truly negative. Right, so kind of think about that, right? You know, when you are deciding between equity, REITs, or even bonds. So on the topic of bonds, it seems like, as I hear myself speak, I seem to be alluding to myself that that bonds, investors should pay attention to a little bit more bonds. So I just wanted to share, you know, our handsome investment director here, Bertram. He's the portfolio manager for our 2 fixed income ETFs, and you know, same question to him. You know, what is top on his mind for the next 6 months? And again, to quote him, we are in a classic liquidity-driven market. I think everybody knows that. And smart liquidity has an eye for the safest haven assets. And indeed, 20% over the past 2 years in Singapore government bonds. And you know, even till today, you know, Singapore government bonds are still quite attractive. You know, from looking at their 10-year real yields, in the table on the right. You'll see that as of 30th of June 2020, you know, the yields are still running at 1.7%. You think it's low, but look at the US, you know, German, as well as the Swiss government bonds, and even Australian government bonds, they're all negative, right? And Singapore, as I mentioned earlier on, Singapore government bonds have the highest credit rating, AAA, from all the major credit rating, global credit rating agencies, Moody's, S&P, and Fitch. And even the US, you know, only has a AA plus from, I think, S&P. And if I'm not wrong, Fitch is has a negative outlook on their AAA rating for US treasuries, right? So things are looking challenging for the US as well. Now, an important comment from Bertram for his views is that he recognizes that the outlook for interest rates is to be lower for longer. I think our investment managers are generally very cognizant that central bank support is really maintaining, keeping interest rates really, really low. And so this is critical. And as a result, it does improve the risk reward for the Sing dollar bond market. Now, to talk a little bit more about the Singapore dollar bonds, in terms of basically the ABF Singapore Bond Index. I mean, that's what I'm trying to show here. This is the historical yields, just to give everyone some perspective. And these yields are actually yield to worst. And I repeat that again, this is yield to worst. It's essentially, the typical yield to maturity of a bond, adjusted for optionality, right? Basically call options, right? So, I mean, it's essentially, issuers sometimes have the option to redeem their bonds early. And when they redeem their bonds early, the yield that the investor can potentially earn would go down, because if you call the bond early, then the period in which you can earn from the bonds, naturally kind of shortens, right? So your returns are typically low. So it's yield to maturity here. Yield to worst here. And it has ranged between 1.5% to about 3.5%. And today, I think at least as of the end of last year or December, it's just around 2%. But what's probably more important is that when you look at calendar year returns, in the chart below, you'll see that the average return on a per year, over the past 2 decades have always run at about 3%. So, and that's quite expected when you invest into Singapore government bonds. Now, for those of you who have a sharp eye, you might point out to me that there are periods where the calendar year returns are negative. You'll see that in 2003, 2005, and 2013. And interestingly, they all corresponds, or most of them corresponds, to periods where yields are very low. Right. So depending on, I mean, there's some historical relationship here, at least based on what we can see, between the yields that you might potentially earn from government, the SGD government and sub-sovereign bonds, and the calendar year returns that you might earn on a forward basis. Okay, last slide. Last 2 slides for me. So I see that my 30 minutes is coming up soon. So really, I think it's quite timely to kind of share, the credit market, the SGD credit market. So as I mentioned earlier on, we have ABF Singapore Bond Index Fund, as well as an investment grade, ETF, corporate bond ETF. And to quote Bertram on the credit market, the Sing dollar credit markets, he says that he kind of sees attractive value coming out from the carry of wider spreads and the potential spread tightening of corporate bonds as the economy improves. So generally, Bertram has a slightly more positive view, on how the corporate bond markets will trend. And although he's still generally very, very cautious on the overall weak economic outlook for Singapore, but from a credit spread perspective, I think he thinks that there are some opportunities there, and this is kind of shown in the chart on the right side, where you should be looking at the dark blues portion here. That really represents the spreads that we are seeing in the SGD credit markets today, and after the COVID. The start of COVID in March this year, yes, spiked to about 170 basis points, and this is higher than what we have seen historically, right? So should spreads not kind of tighten again, narrow again, there could be some upside to SGD corporate bonds. And slides to show to explain why he thinks the SGD corporate bond market might do quite well, or relatively better, is that you see here that on the left side, the supply demand picture is actually looking quite good. You see here on the left side, the two charts shows new issuance of investment grade bonds, and you see that overall in Asia, that's the top left chart. If you look at the dark blue portion, new issuance for investment grade bonds, US dollar denominated investment grade bonds have actually risen. So supply has actually increased. But when you look at the SGD market, right, for investment grade, that's the chart below on the left, you see that the supply has actually shrunk from about 2.7 billion to only less than $1 billion in the first half of 2020. So supply demand looks good, and the chart on the right, the historical spreads, relative to its own history since 2012, SGD credit spreads are only somewhere in their long-term mean. So really not very expensive from this perspective. Last slide for me. When you kind of put everything together, when you try to put Singapore equities, you try to put REITs, you try to put bonds all together, how do you look at the portfolio, right? So for this, I went to Wing Kwong, who is our group head for portfolio solutions, and he kind of mentioned, so to quote, base case for Singapore is to be tactically overweight equities and underweight fixed income. And of course, he favors credits, right? So, which is really the credit market that I just mentioned earlier on. And of course, this is over the short term. And maybe just one last point is really that he is cautious, right? Generally, I've mentioned right from the start that economic data does suggest that we should take a cautious stance, right? And in particular, he is most worried about the sustainability of Singapore REITs as well as the health of bank balance sheets. He is also very mindful that Singapore is not really seeing the recovery that we are seeing in our larger peers, maybe say, in the rest of Asia, because we are just we don't. A lot of the recovery has been manufacturing led, but Singapore doesn't really benefit that much from manufacturing. In fact, all the numbers are showing declines in manufacturing, and we are also more exposed to the weakness in global trade, right? As well as we got our domestic economy is small, so we don't benefit from consumption much. So these are all things to be mindful about. And last point from me, if you kind of look at the STI, right? Look, I think it's just, despite all the challenges, I think I just want to point out that from a price to book perspective, the STI, is trading at probably a decade's low at 0.9 times price to book, and the dividend yield is still looking fairly decent, of about 4.5%. And this is before the banks announced that they might, cap their dividends. So please be mindful of that. But from a book perspective, right? From a book perspective, Singapore is looking fairly attractive from a price to book perspective. So just some points that and tips that I kind of want to share, and hopefully this is useful for everyone. So with this, I end my presentation. Thank you for taking time to listen in.
So thank you once again for joining us for today's session. Thank you, Tejin and Kelvin as well. So yes, we have come to the end, and thank you and stay safe.